Let me just glance at Akamai. Rocky, let's put this guy in timeout 5 minutes. You're asking the wrong kinds of questions, Rocky. Yeah, I mean, Facebook's deals have been the best deals in history. But, you know, the very biggest, the very, 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 very biggest companies, the top 4 companies, Amazon, Google, Alphabet, and Apple, there's really no special acquisition between them. That was really a big deal. There have been a lot of good deals in pharma. Probably Johnson & Johnson's acquisition of Centocor. That might have been the GOAT deal, but there's others. Royalty Pharma did a lot of GOAT deals. Okay, so at least back in Q1, they had a slight net debt position. Yeah, there's like 5 or 6 royalty companies at least in pharma off the top of my head. Yeah, you're thinking of DeepMind, not DeepSeek, but I don't think much of these companies would have changed Google. A lot of them were stuff they already tucked in to the company, or they would have tucked into the company, you know, building it versus buying it. It's sort of like tail wagging the dog. I mean, Google search was the most important thing, and they didn't buy anyone for mail, they didn't buy anyone for maps, they didn't, you know, it was just sort of all organic. I don't know that podcast, sorry. I thought they made maps themselves. Interesting. Yeah, but again, you know, like nurturing these things and growing them is probably. And I'll go back and like I'll talk to some of the people and see what the real story was. Because like the question was like, did that acquisition completely enable it, or was it? What exactly was the story? There's guys like Paul Buchheit and Craig Silverstein that they were there, and you can always ask them. The oral history of Google. Yeah, Rigetti's earnings are going to be bad, which is not going to be good for anyone in the space. I mean, I think Rigetti's earnings are going to be a disaster. hey, Buffett's got a lot of profit. You know, he doesn't. So, you know, the more profits he generates, the more float he generates, the more cash he's got, which makes sense. We're looking at Akamai now. He said he's not bearish. So, I mean, I do think that when you build up cash and you can't find, it's like kind of like me. I mean, I can't find great longs. You know, I can find a lot of great shorts. That sort of just basically means I'm bearish too. Okay. So Akamai, at least in Q1, was growing at 8%, which is, I think Fastly was growing a little bit faster at that time. Yeah, I mean, it's funny because the gross margins for Akamai are not that different from Fastly's, but they're enough of, they're better, and that's enough for them to be, they're like 5 points better. And that's enough for them to be a lot more profitable and get a lot bigger multiple, because Fastly's only 2 times sales, whereas these guys are closer to 3, maybe 4, 3.5, 4. So I think there's something to that. I wouldn't call Akamai a legacy in that case. You know, given they have a lot more revenue and seemingly maybe even more growth and better margins. But again, maybe there's something about the CDN business I don't know. I don't know much about it. And that, you know, they're going to be just fine. That certainly could be the case. Yeah, it looks like growth slowed as well for Akamai, down to 5% at least 2 quarters ago, but probably even more slowing before that. I wonder what people are doing for CDNs. I mean, maybe some companies, I think a lot of companies take it into their own hands, where they're just like, fuck it. If we want to control how meta is viewed on the internet, we better do it ourselves. I mean, Google on their call talked about their laying fiber under the sea, onto the sea. So doing a new project for that. I mean, yeah, just like Akamai, just tons of cash flow. I don't see them buying Fastly or anything. I mean, again, I want to see how, like, what was mentioned is like, are they doing business differently? But even if they are doing business differently, it doesn't look like Akamai is losing anything. Now, could that change over the long run? Maybe. And again, it doesn't mean that just because one company is better than the other, it doesn't mean anything. I mean, maybe with scale, you know, they could be like an Akamai. Yeah, so is Akamai doing like $1 billion in cash flow a year? Maybe not quite $1 billion. Let's see. Akamai could be cheap. I mean, people will always need CDNs. Like, we don't want to set up servers. And I think Amazon, AWS has a product like this. I don't know if it's Route 53 or what exactly, but they have a product like this for CDNs and local delivery, edge delivery. Okay, so here's a little bit better, more current financials. 150 million shares outstanding for Akamai, 12.5 billion market cap. I guess edge compute is a pretty big growth possibility. If you want to put GPUs on the edge, I do think, you know, the best GPU on the edge is the user's GPU. They're more security than delivery now, Akamai. That's interesting. Delivery, they're dropping like a rock. Maybe they are losing share. Co-location fees, bandwidth fees was interesting. They really break out their cost of revenue. You're the edge. Still need fast delivery, one way or another. This is a really amazing disclosure here for Akamai. They're super generous in their disclosure. You don't have to tell us any of this. That's nice of you. And they have $2 billion of machines out there that, again, they have to constantly refurbish and all that. All right, so 14 billion enterprise value. Let's see. You can see the revenue was solid, you know, slow and solid growth. There's nothing wrong with that. This is like a normal real business. We look at all kinds of insane businesses. 5% revenue growth. It's nice to look at a real company sometimes. It's the kind of company where the CEO's hair isn't on fire every day. Can you imagine managing like one of these super high growth companies? Oh, wait. Hey. you guys been keeping up with levels.io? For all you guys at home, like what Levels does is very much what you all can do. If you want a quick $1 million, Levels is very talented, but I also think some of his ideas aren't that good either. You could probably, starting today, make $1 million next 12 months, at least on a run rate basis. Levels.io, check him out. That's his name. That's what his mom looked at him and said, "You're Levels.io." He looks like a .io. His dad was .com. They looked at him and said, "You're Levels.io." Beautiful kid. Well, I mean, just look at what he does, and he's probably a better programmer than a business person. So if you have some business skills, I'm not saying necessarily you learn them from me, but a couple of good business ideas and some focus, I think you could do what he's done. So check him out, yeah. Check him out. Shkreli's not going to lead you wrong. Yeah, I've never seen his Lex interview. I tried to buy one of his companies. This is a hilarious story, guys. So nobody knows the story. Not even he knows this story. So I DM him, right? And I go, "Hey, can you call me?" I give him a phone number. And he goes, "Oh my God, I'm a huge fan. I can't believe you're DMing me." I'm like, yeah, great. Here's my number. I need to talk to you. I want to talk to you. Give me a phone call. And I want to buy one of his businesses. Pay cash for it. He doesn't know this. And he goes, "Sorry, I can't call." I go, "What?" He goes, "Yeah, it just wastes too much time. I have to build." I'm like, "All right, bro." I'm not trying to waste your time. I'm not trying to waste my time. You fucking think I like sitting there making phone calls a day, chit-chatting on the phone? Yeah. It's all good. Just want to chit-chat with my buddy. Levels.io. Nah. Who the fuck you think I am? I unfollowed him after that. Yeah, nobody knows that story. I mean, I probably shouldn't take it personally. I mean, he's obviously just an autist. And maybe a rookie. You could take a phone call. You just have to, what you have to do is just keep it to like 5 minutes. So like, no matter what happens, just be like, "Oh, hey, I gotta go, my dog's barking." If you do that, you're fine. Yeah, look, I mean, it's not a big part of making money, but if somebody wants to talk to you, so what can I do for you? And if they say, "Oh, I just wanted to chat about," and they say, just say bullshit, then you say, "Listen, I'd love to. I'm in the middle of writing this thing. I need to get done by midnight, so let me set up a time to call you later." And then you just never set up a time. That's the polite way to do it. It's not that big of a deal. Oh, did I not change the date? Shit. Oh, wells. You know what time it is. So Akamai's cheap, man. Fucking Akamai's 14 times. I can change the stupid date. 1 second. Okay, date should be changed. Thank you. I thought I did change it. I guess not. Yeah, we could look at Cloudflare after this. Security grew 16% for them. That's not bad. It's delivery that worries me. But compute also grew pretty healthy. But yeah, CDN has been dropping like a rock. I wonder if that's just margin compression in this business, because it's like anybody can do it. AWS can do it. You can do it yourself. But yeah, security and computer. It's interesting because you look at the company and you say, okay, well, steady growth, but underneath the hood, you actually see a bunch of tumult where delivery is dropping like a rock, but security and computer growing to offset it. So it's actually not as calm waters as it may seem, just growing 5% a year quietly. Yeah, I know Relics. We're still working on Akamai right now, so hold your horses. I'm going to take a deeper dive in Akamai because it's so interesting. And we're going to look at some metrics we usually don't look at. So I think you guys will enjoy this. The key is looking at property, plant, and equipment. I mean, this is, sometimes I say PP&E, property, plant, and equipment, is the heart of business. And you can't really understand business without understanding what property, plant, and equipment is and why it's so damn important. So as you guys may know, PP&E is sorry, I'm just looking at the bands here. PP&E is any purchase of equipment. It doesn't have to be equipment, by the way. Basically anything that lasts, that where its useful life, meaning how much time will it take for you to fully use it, is more than 1 year. So a desktop computer is actually PP&E. So there's a lot of PP&E in there that's like not kind of what you think it is. But like obviously a huge machine, I don't know, extreme ultraviolet machine or something would be PP&E, or just a huge drill, that industrial sized drill that's $1 million or something like that. So that's what PP&E is. And so a lot of the metrics on in finance are related to PP&E one way or another. Or sometimes people just call it capital or capital equipment. There's a lot of ways to sort of describe it. And we'll go through that in a minute. Okay. So they have a $10 billion in assets. But goodwill is like 4 billion. So the tangible assets are 6.5 billion. Okay? And it's a $14 billion market cap. Now, assets are meant to create cash flow, but if you think about it, if you shut down the company today, you'd have $6.5 billion of stuff. Whether or not you could turn it into $6.5 billion of cash is another concept. The lease right of use, for example, is kind of a wishy-washy asset, and it's a new concept for accounting standards. You used to not have to put in leases, and that sort of changed accounting in a lot of ways that a lot of people don't like, but it's not a huge impact either way. You do have a bunch of debt with this company, so it's not like you would get a pile of cash for shutting it down. The reason people are willing to pay so much for it is because it's an earnings gusher. It just makes tons of cash. Yeah, IFRS changed because of this too. So RM Trade knows what he's talking about. Haha, Rocco Russo. Well, you can invest in the company if you have a huge amount of money. If you don't, make sure you subscribe to Godel. If you don't want to do that, or I think you are a subscriber, you could subscribe to somebody, help somebody in the chat or something. I don't know. Give them a subscription. Gift a subscription. But I appreciate it, obviously. Okay, so I'm just finishing out the balance sheet here. Yeah, and you can see that the leases are symmetrical on both sides. Godel is very similar to Bloomberg. So if you watch a Bloomberg, let's go Flood. If you watch a Bloomberg video, you will understand Godel. I'll make some Godel videos, and then you'll understand Bloomberg. But they're basically, we learn from the best, and we made it better. There's a lot of problems with Bloomberg, which is why we made the software, because we need the software for ourselves. And you're going to see a lot more cool things. We're working on some other tools that are less commonly used. These are, honestly, Bloomberg, yeah, I mean, I shouldn't say too much. I'll say this. The Bloomberg tools are relatively simple. They're not really doing magic for you, right? I mean, they're helping you get the news. Now, it's very complete, and you can count on it. It's dependable. That's important. It's thorough and complete, but it's still pretty simple. And the same thing applies to the other companies. Nobody's made really advanced software. There are some tools out there. LiveVol is a good example, but it's like very idiosyncratic to one thing. But the amount of tools there are for super professionals, there's some out there, but the average person can't use them because they're basically impossible to use. You have to really understand what the heck you're doing, and I think some of the stuff can actually be dumbed down pretty well. So we're working on some cool things. I think the thing to know is that the days of the fundamental analyst are coming to an end. And how do we prepare people for that sort of shift? And I think that there's a lot of things we can do to help not sort of let Wall Street destroy everyone. The five Wall Street firms, basically, kill every trader and every investor out there. That's not fun. So, how do we fight back? And I'm on the fundamental side. I worked for a Tiger Cub. I didn't, ever want to do machine learning. I never wanted to do market making. But, I followed quant since I was a kid. as well, and I was always mystified by how these guys could beat our pants off every year. We worked so hard looking at stocks, and they would just trounce us. And I think if you can't beat them, join them. But also, I wouldn't mind, helping everyone learn how to do it, and then the playing field will be even again. If the playing field's even, that helps everyone. So you have an armamentarium of tools to potentially go after folks. Quants aren't ripping people off. No, I think quants are making trade-offs. So they're making smart trade-offs, probabilistic trade-offs. And I'm going to show you exactly how this works, and I'm going to even make you tools that you can link with brokerage APIs to do it yourself. The biggest thing that you have to understand about this is that fundamentally quants really do well. Here's an intraday chart of Pfizer. This is a really good chart for a quant. Basically they're a market maker, so they're sitting on the bid and the ask, and they're willing to offer you merchandise. It's kind of one way to think about it, is inventory and merchandise. Imagine you're a retailer and you're stocking toothpaste. I don't have toothpaste out here, but let's say I have this Afrin, and you got 1,000 of these Afrins, right? Now a retailer only sells, but they do have to buy from their supplier, and they have a fixed bid ask, right? They're buying this thing for $2 and selling to you for $3. Well, the market's sort of like that. And to be a market maker, you have to say, I'm willing to buy at, say, 26.40, and I'm willing to sell at 26.42. Now, what's the problem? Well, if you get hit on both sides at once, I think I went through this the other day. If you get hit on both sides at once, 26.40 times 26.41, you make a cent. It's wonderful. Now, this is a spread that's very tight. You might instead want to do, say, 26.35 and 26.45. Now, the odds that you're going to get hit at the same time on this are pretty low. But let's say you don't need to get hit at it within 1 second. Probability that both of these trades go off in 1 second is not bad. And on 100 shares, you make one single whole dollar. But, on this one, you make $10. Now, $10 doesn't sound too exciting, but it doesn't have to be 100 shares. It could be more, and it could be every stock in the stock market. So if it's an extra, let's make it 1,000 shares. That's $100. And let's say you're doing this on 1,000 stocks, and you're doing that in 5 minutes, and you have enough money for this right now. I mean, that's 1,000 shares is only $26,000. Now, you may not have enough money to do it in 1,000 stocks, but if you do it in 1,000 stocks, that's $100,000 in 5 minutes, and you could linearize that, and you can see just let's see, in an hour, it's 12 times that, so it's 1.2 million in an hour, and it's about $10 million in a day if you successfully pull this off. Now, I'm not going to give you any illusion that that's necessarily possible, with this amount of capital. But it is possible. It's just a question of how much capital you need. And you will have losses and things like that. So I did talk about this last week. So in essence, as you sell here in this situation where the stock's rising, you are accumulating a short inventory. You might be short $5,000 by the end of this. Now, you might also hedge. You might say, I'll buy SPYs to offset this or something. And as it goes up, you might say, I'm going to lighten my load on how much I'm willing to sell. Instead of 100 by 100, I might say, I'll buy 1,000, but I'm only willing to sell 100 at this point because I'm so loaded up on short merchandise, short inventory. But look, obviously, if the market comes down, you really kill it because now you cover your short. What quants don't want is charts that sort of look like this. And there's plenty of growth stocks like that, and they're really hard to trade. There's other ways to make money in quants that will offset your losses, but making a market in something that's a straight line up is very tough. You basically will be rolled over and lose money. So if you have more of a chart that's like this is your just money printer. And so you can kind of leverage off of the options market and say, well, what's the implied volatility? The options guys are smart. If there's a lot of vol, maybe it'll be the case where it will be a market like this or somewhat like that. If it's not a lot of vol, maybe it'll look like this. So that's just sort of one clue. And again, we'll talk about doing this with multiple securities at once and what kind of things that brings. But I really don't think it's as hard as people make it out to be. No, I mean, I don't look at charts the way a lot of traders do, which is they try to divine what's going to happen. And look, Paul Tudor Jones does that. He's one of the best traders of all time. Steve Cohen does that. So it's not like you shouldn't do it or you can't do it. It's not my style. But the quantitative style, I think, is going to make a lot of people a lot of money. It already has made everyone else a lot of money. But I want it to make money for you and me, and for smaller hedge funds that don't necessarily, think they can do it. But I think that they're a lot smarter than they think, in that they could actually run quant books without too much trouble. I think there's this opinion. I was talking to one guy who actually was Citadel's first investor, so reveals who it is, but some Chicago guys. And I said, you invest in quant? This is 20 years ago. I said, are you in D. Shaw? Are you in this and that? And he said, no. He said, I think that space is an oligopoly. It's not understandable to me. The guys that do it well seem to do it well, and they don't tell us how, and that's it. And I think he was wrong, and he missed, if he kept that opinion, I don't know if he did or didn't, but if he kept that opinion, that was the wrong opinion. That opinion became, there became a lot more firms that did that well. So it wasn't Frank. Frank was basically Ken's partner. I put Frank on the inside of Citadel. I'm talking about the first sort of outside investor. Again, you'll figure it out. But point being that I don't know how we got off to quant, because I want to talk about return on assets. But I think that the general idea of some of these algorithms is simple to understand. Implementing them is not simple. Implementing them really, really well is not simple either. But, some of that should probably be best standards, or like something you can rely on a third party to do. Because ultimately it's plumbing. Now, choosing which stocks you want to run what algorithms on, that's also a decision you sort of have to make. But I do think you can compete with some of the other quants. A lot of these algorithms are fairly similar. So in any event, that's kind of what I want to get at. Again, the story gets deeper and more complicated, but let's focus on PP&E, again, the heart of business. So Akamai spent $2 billion at some point on equipment. They have $2 billion of boxes. From this, they make $1 billion a year in cash. Think about how great that is. That is a wonderful return. That's a 50% return. Imagine you said, oh, well, I can come up with $2 billion. And if I come up, let's say, it does, maybe not you or me, but Ken Griffin could say, well, I'll come up with $2 billion. Would he make $1 billion? And he'd have all the same machines that Akamai would have. And of course, there's a reason they have $4 billion of revenue. They have relationships, they have sales and marketing, they have a brand name, all that stuff. So, it's not that easy. But fundamentally, you could actually create, just think about this in your mind, a carbon copy of Akamai with $2 billion. You could copy and paste it. Now, it would take years to sort of build it up to the business that they build it up to, but you wouldn't have a fundamentally different business. And I think that's the sort of the heart of things, because if your yield, you can think of it as a yield almost, and people will do different returns, but there's this idea of return on equity, and so equity is shareholders' equity, and so in this case it's 23%. You could do return on tangible equity, which is our return, which is free cash flow, and we're going to divide that by shareholders' equity minus the goodwill, and that's a hell of a return. You can do return on assets, same sort of calculation, and then you can do return on tangible assets. Again, minus the goodwill. So whichever metric you use, you sort of ask yourself, well, if they can get a 50% return. That's sort of, there's one called the Buffett return, which is my favorite. And this is something that is hidden away in a book that is like basically out of print. But Buffett disclosed his sort of favored metric for return, which is really interesting. And I have it written somewhere. I just don't want to mess it up. Yes, here we go. Okay, so the Buffett return is inventory, which this company does not have, plus fixed assets. So this is sort of what I was talking about, which is a 57% return. So I think that, you know, it doesn't matter that much which return you use. I think the Buffett return like crystallizes it pretty well. You may also want to add in accounts receivable because ultimately AR is capital that you've put out, basically. You may even want to add prepaids. I don't think you want to add the longer term stuff. So in any event, you know, here's a company make a 57% yield. It's good and it's bad. It's such a high yield that AWS might say, hold on a second, I can buy some boxes. We have distribution. There's nothing that's stopping me from making a 57% return. That sounds great. Because keep in mind that to keep this up versus the depreciation, they have to put in another $390 every year. That's their capital expenditures. So maybe you want to add that too. What do you think? Maybe? Because you are depreciating this number. But you're also expensing it in depreciation and free cash flow? No, you're adding it back. So I think it's okay to look at free cash flow. Because otherwise, if you do it, if you expense capital expenditures, you're expensing it twice. So it's already coming out of free cash flow. So I think that's fine. But you do have to maintain that by spending capital expenditure. But that's not a big deal because we are doing it this way. So anyway, think about it this way. This property, plant, and equipment is a one-time purchase. Okay? So you have $2 billion, but this $2 billion is giving you $1 billion every year. Like imagine a 50% return hedge fund or something. You spend $2 billion once. I clean up $1 billion this year, $1 billion next year, $1 billion next year, $1 billion maybe in perpetuity. Well, it's your job to model, is it in perpetuity or not? But from a business owner perspective, this is like the greatest thing ever. From a stock market perspective, the stock is just what people are willing to pay for it. And they're willing to pay 14 times earnings for it, 14 times cash flow, EV to free cash flow. So for a non-grower and arguably business in tumult, that doesn't sound too cheap and it doesn't sound too expensive. I'm sort of attracted to it because 14 times is hard. It's kind of hard to get in most markets. But, you know, in a downturn market, maybe that's 10 times, you know. And then the question is if they can ever grow again, and it's not a business under siege, if they can ever grow again, you know, it'd be a really, really big gainer. You could probably double your money if they're ever going to grow again. And that depends on your assessment of management. Are they good? Are they not so smart? You know, you got to make up your mind on that. And that's not something that is simple. In fact, the best managements, you know, you basically just have to look them in the eye. So my first big billionaire investor, I asked him how he did what he did. And he basically, with like a Texas drawl, said, I look them in the eye. And if I like them, I buy. And if I don't like them, I sell. I thought it was the most profound shit I'd ever heard. And, it was. It's true though. It really is true. Um, he wasn't an oil and gas guy. Ironically, he became an oil and gas guy later. Actually, I think he kind of got washed on oil and gas in the shale boom. But in any event, that's not the point. The point is, he's right. That is sort of how you have to deal and assess management, because management's all you got at the end of the day for a lot of these companies. Not for every company. For some of these companies, you've got such a good brand and such a good, business that you can outlast management. And we all know Buffett's famous saying about that. But, for most of these businesses, you're really at the mercy of that CEO. And if they fuck up, you're cooked. So, you have to be pretty sure that you like the guy or gal running the business. And if you don't, it doesn't matter what the fuck the earnings ratios are, right? I mean, I've seen people ruin great companies, and the evaluation was attractive, and it turned not so attractive, then it turned awful, and then it turned to bankruptcy. So you can't really buy stocks like that. Now, if you're going to kick management out yourself, different story. And then you've seen the opposite. Look at Palantir. All right, company goes public, excellent management team. Gosh, the stock's a little too expensive. I don't know. I'm going to sit this one out. And it turns out that they grow way faster than anybody thought because they're such a good management team. And when you have a great management team like that, you're willing to pay almost any price. And obviously, I caution a little bit against that. Tesla's, again, a really good example. When we added up the theoretical value of the company, there's a lot of value missing, and that value is Elon. So I think IVVD is an okay speculative buy. It's a COVID play, and COVID is still around, believe it or not. People still get COVID. People still get hospitalized for COVID. It's sort of shocking. If you had a loved one that's 80 years old or something like that, the IVVD product's better than the Pfizer product. It's not a vaccine. It's a long-acting antibody. So it doesn't mess with your immune system at all. This is honestly what we should have done if we did try to do it with the Regeneron antibody, but it comes too late, of course. But in the throes of COVID, it would have been nice to have this thing, because this antibody lasts like 24 weeks or something crazy. But again, the problem with the antibodies, they're not all perfect either, because they tend to be to one conserved region. I mean, vaccines theoretically are too. One conserved region of the protein. So it's possible that, you don't get the full protection. But I like the IVVD thing. And they're selling the product now. They're making money. It's really hilarious. It's trading, at cash, and they're making money. It's like, no brainer. All right, I did want to look at Cloudflare. I guess Akamai is sort of security too at this point. I do like PayPal. I think all the payments companies are really attractive. One question is what's going to happen with stable coins and things like that. I mean, I think we're still a little bit of a ways away from using stable coins to pay. But if you're like me, a lot of people really don't like, really don't like Visa and MasterCard. They're just sort of kind of just an annoying, I don't think the legacy payment companies are going to allow their lunch to be eaten by crypto that easily. So keep that in mind. But I think the fraud prevention and stuff like that is definitely, rebates, refunds, all those things. There could be issues there, but in general, we could move from a toll on the money highway more to a stable coin revolution, which I think would be great. Certainly for certain products. A lot of products just, you don't need this MasterCard Visa shit for. And, developers have to get used to it. I think Stripe is letting you, do, some crypto transactions now, which is good. But the most important thing was the government. The government didn't want you receiving crypto. All right. Yeah, they're kind of amazing businesses, and they can handle a lot of transactions, but so can crypto. And I think crypto can take a lot of volume away from these guys. There are some questions about just how much volume can crypto handle, but we'll see. Solana seems like it could handle a lot of volume. And for most people, they don't care about the maxi-isms of like, is it truly decentralized and stuff like that? I don't care. As long as it works, gets my money to where it needs to get to. I don't really give a shit. Okay, so Cloudflare's had a big boom since we last looked at it. $50 billion company. Really big numbers there. They had that big scare, right? Or am I thinking of the other one? Which one had that big problem? Was it Cloudflare? Or was it CrowdStrike? I think it was Cloudflare. Oh no, it was CrowdStrike? Okay, so it wasn't them. This is the Lava Lamp company. All right, let's look. Interestingly, Akamai has more revenue than Cloudflare. Cloudflare's just growing like crazy. So they are going to overtake them on the revenue side, but it's not fully, baked in yet. Yeah, really impressive revenue growth, 30% revenue growth for a while now. Again, anytime you see a business like this, you got to realize there's something special going on. Yeah, maybe we should just compress all the stuff that's not the financial statements in the 10K. Okay, yeah, so growth went down, I should say, to 27%, but still remarkable growth. Maybe slowing. Biggest cost, sales and marketing. It's really nice when you have a model already made, so I only have to update one or two things. It takes me 2 seconds. That's why it's worth putting in the work. All right, cash flow, they're kind of a monster. Let's see. Okay, so free cash flow is 200. So it's like 100 times. Oh no, it's more than that now. What's their stock price again? 147. So it's a 50 billion EV resting on 200 in cash flow. Yikes. So it'll be 25 times earnings in 2029. Just saying. That doesn't mean cash flow can't double. I have it doubling. Let's look at their balance sheet just so we understand. Their property, plant, and equipment is just 467 million. So we were talking about rebuilding Akamai for 2 billion. So these guys only have 467 billion. They only make 140 or 200. So it's still a growing business, but I don't know. This could be like a contrarian bet of long Akamai, short Cloudflare. Cloudflare is a little different. They have technology that I think people trust quite a bit, but ultimately, technology is rarely a moat. We'll have to learn this space a little bit better. I mean, I'm glad I'm up to date with the numbers. We started with Fastly, which sort of seems like a piece of trash, but that was fun. All right.